Hello everyone, in this video I'm going to show you my biggest losers in my portfolio and talk about what exactly I'm doing with them. I'm not going to show you my winners because I did cover those a lot in this channel already, so we are not celebrating anything. We are opening up the portfolio and we are going straight into the stocks which are in deep red, and trust me, there's a lot of it right now. Last year it was very smooth sailing. Almost everything I touched worked. Very few losers, but this year the losses are stacking up, and instead of pretending they don't exist, I'm going to walk you through every single one, their numbers, valuation models, balance sheets, and technicals, because in real investing you must face both profits and losses. With that said, let's start with the first one in the list, which is Chipotle Mexican Grill. I currently have 200 shares at an average cost of $42.23, and I'm down about 8%. It seems to me on the monthly chart, Chipotle is just starting to turn bullish. So, from a technical perspective, it's showing early signs of strength. Fundamentally, it's not looking good right now. They are generating about $1.45 billion in free cash flow, but they do have $8.8 billion in net debt. That's something to monitor. And when I plug this into my valuation model, I'm seeing a $78 price target in 5 years. That's 100% upside. Now, maybe you are thinking that's too optimistic. I don't want to just rely on one model, so I'm using a lot of different models before investing. For example, their historical CAGR model, which is projecting the price of Chipotle around $80 in 5 years, and free cash flow valuation model is projecting around $50. And Wall Street analysts are seeing $44 price target in 1 year for Chipotle. And my intrinsic valuation model says fair value range is between $23 and $37. So overall, we are in a bit above intrinsic value range right now, but in the long term, I'm confident Chipotle will do really well. I'm planning to hold for the next couple of years, possibly even increase my position to 5% of my portfolio, which means buying another 100 shares. And next up is Trade Desk. This one really hurts. I have 450 shares at an average price of $35.56, and I'm down 28%. And it just keeps going down. And it's going through AI disruption fears, competition from Amazon, and the narrative is brutal. But let's slow down a little bit. They have $1 billion in net cash, free cash flow of $687.5 million, and price to sales ratio of just 4.47. That's cheap for a company like this. My model shows 5 year price target of $151, and analysts on Wall Street says $50 price target in 1 year. My intrinsic value model says fair value today is around $33, which is still above where it's trading right now. And here's something interesting: hedge funds are actually increasing positions at these prices. So I agree we do have a short term pain, but in 2 to 5 years time horizon, I think this one will turn around. Let's move on to the next one, which is Duolingo. This is one of my biggest drawdowns in my portfolio. I currently have 35 shares at an average cost of $265, and I'm down 57%. That's really painful. And I don't even know where to start with this one because fundamentally it's really strong. Their projections are excellent, valuations are looking really great, but investors are scared. They are saying, why learn languages if AI can just translate it for you? That fear is crushing the stock. I'll do a separate deep dive on this, but here are my projections. I see 180% upside in 5 years, which puts it over $300. And based on free cash flow growth model, it could go over $700. Based on forward valuation, it could be at least at 2x. And even Wall Street analysts are projecting $250 price target in just 1 year. So this is a pure sentiment play right now, and the sentiment can flip at any time and it can happen so fast. All right, let's move on to the next one, which is UiPath. I currently have 225 shares at an average price of $14, and I'm down 20% on this. Again, it's because of AI fear. And this is what it's funny. All these companies supposedly at risk from AI actually have real customers and real recurring revenue. Look at their balance sheet. They have $1.33 billion in net cash with $311.5 million in free cash flow, but price to sales ratio of just 3.82. Based on free cash flow growth, it could be a $76 stock in 5 years. Based on forward valuation, we could see $28 target, and that's 150% upside. My own model says 120% upside in 5 years. Even Wall Street analysts currently rated it as a hold rating with $16 price target in 1 year. And I'm not just using one framework here, I'm blending fundamentals, technicals, intrinsic valuation and future projections. So let's see how this one plays out. All right, moving on to the next one, which is Netflix. I have 40 shares at an average price of $98 and I'm down 20%. Technically, it's sitting at a major support level right now at 200 EMA on the weekly chart. If it can hold this level, we could easily see $100 very soon. I've placed my GTC order to buy another 40 shares at $76 to bring down my average and accumulate more shares at these levels. On based on the historical CAGR and forward valuation model, I'm seeing at least 100% upside on Netflix. Using my model, I see 163% upside in 5 years, which would be around $200. Wall Street analysts are also rating it as a strong buy with $117 price target. And Netflix has an intrinsic value of $114, which is way above current price. So overall, I'm holding and I'm buying more shares at these levels. All right, next up is Hims and Hers Health. I currently have 100 shares at an average price of $30 and I'm down 48%. 2025 was a great year for Hims. They had really strong user base, good free cash flow, but things flipped very quickly. All of a sudden, everyone is bearish right now. I'm waiting for earnings next week. If the guidance and numbers are good, I'll hold and add more, else I'll plan to sell. My model says 400% upside in 5 years, but intrinsic valuation suggests more downside right now. So I'm honestly debating whether to hold or sell. Let me know your thoughts on HIMS and what are you planning to do with your shares. All right, next up is ServiceNow. I currently have 100 shares at $145 and I'm down 25%. This one at the wrong time, literally dropped 20% right after I entered. Cloud model releases triggered panic across SaaS companies. But here's the thing, market leaders always adapt, they don't disappear. So I don't think ServiceNow will be disrupted by AI. They have a solid balance sheet with $3 billion in net cash and price to sales ratio of just 4.8 for a $112.7 billion market cap company. That's not expensive. And based on my three valuation models, I'm seeing at least 100% upside. And in the worst case, if growth decelerates heavily due to AI fear, I see negative 35% in 5 years. That would be devastating for me. But look at this, Wall Street is extremely bullish on ServiceNow with $429 price target. And my intrinsic value is around $65. I honestly don't think it really goes there, but if it drops to that level, I'll be in a big trouble. Moving on to Robinhood, I currently have 100 shares at $120 and I'm down 37%. Feels like every stock I bought this year is keep going down. This one moved almost tick for tick with Bitcoin's fall from 120,000 to 65,000, but that doesn't fully make sense to me. Robinhood is more than crypto. They've got betting markets, commission revenue, margin interest, new Gen Z investors opening accounts constantly. So I think this is just a temporary dip in the long-term rally. Their balance sheet isn't in a great shape right now. They have $7.37 billion in debt and $1.59 billion in free cash flow. Analysts on Wall Street are seeing at least $134 price target in 1 year, and my model is not showing any upside right now. So this one is kind of a mixed for me. Let me know what you think about Robinhood in the comments below. Moving on to C Limited, I currently have 100 shares at $134, which I am down 16% on. Their balance sheet looks really strong. They have $5.68 billion in cash and $3.9 billion in free cash flow. My model says 250% upside in 5 years, and based on free cash flow growth model, it's projecting 500% upside. And analysts on Wall Street are projecting $175 price target. It's under pressure right now, but I think it will move back above $150 relatively quickly. I'll be waiting patiently on this one. And to the last one, which is BMNR. This is one of the largest holder of Ethereum. I currently have 150 shares at $24.50 and I'm down about 19%. This dropped due to the whole crypto market. I believe in crypto long term, so I'm not worried here. I'll probably add more if I get a chance, but I'll hold patiently for a massive upside. So overall, I realized I have too many positions and managing these many deep losses names takes time, conviction, and capital allocation with discipline. So I'm seriously considering trimming some positions and reallocating into my highest conviction place. So there are a few positions which are also down 1 to 2%, but I'm not worried about those right now. Big question is, do you double down on fear or do you consolidate into your strongest ideas? That's where I'm at right now. Let me know in the comments, are you holding any of these names? Are you buying the dip or are you cutting losses? Because this is the toughest part of investing. That's all for this video. Thanks for watching and I'll see you in the next one.